So for this deep dive, we're tackling Uber technologies. Specifically, we're looking at its pretty stunning transformation. How does a company famous for burning cash become this, free cash flow compounder by the end of 2025?
That transformation really is the whole story. The entire investment case has shifted.
We shifted how?
Well, we've moved completely away from that old speculative bet on just ride-sharing dominance.
Right.
Now it's squarely about fundamental analysis. It's about efficiency and real, on-the-books, gap profitability.
Okay, let's unpack that because the contrast it's pretty stark. You have to remember the two Ubers.
Two completely different eras.
First, there was the Kalanick era from 2009 to 2017. That was all about scorched earth expansion.
Market share at any cost. And it led to huge legal problems, zero profit.
Exactly. Then Khosrow Shahi comes in and the mantra becomes profitable growth.
And that required some ruthless decisions, rationalizing the portfolio.
What does that mean exactly?
They cut their losses. The self-driving ATG unit, gone. They exited markets like China, Russia. That discipline is what led to the first full year of GAAP operating profit in 2023.
Which brings us to 2025.
Yeah.
And this huge signal of validation, that $20 billion share buyback.
Yes. That announcement in Q2 basically killed the cash-burning growth stock narrative for good.
It's a huge vote of confidence.
It is. But this is where we need to add a little nuance for you, the listener. Let's talk about the Q3 net income.
The $6.6 billion number, that looked enormous.
It did, but it wasn't all from operations. A big chunk of that, $4.9 billion, was a one-time tax valuation release.
Wait, okay, break that down. How is that different from cash profit?
It's more of an accounting signal. Think about it. Uber lost billions for years.
Right.
Those losses create a massive tax shield. Once the company can prove it's going to be reliably profitable, it's allowed to, release that reserve onto the balance sheet.
So it's a good sign for their long-term health, but it's not like an extra $5 billion in cash showed up that quarter.
Precisely. It shows they believe the profits are permanent, but it's not operational cash flow.
Got it. So let's look under the hood. How is the new Uber actually built to generate these profits?
It all comes down to what they call super app synergy.
Okay.
That synergy is the magic formula. It's all about lowering customer acquisition costs, or CAC.
Because mobility and delivery are in the same app.
Exactly. Mobility did, $25.1 billion in gross bookings in Q3? Delivery was right behind at $23.3 billion. They reinforce each other.
So you open the app for a ride, you see an offer for food delivery.
And boom, you've acquired a customer for two businesses with one app download. The cost is tiny.
And inside delivery, the real growth engine now is grocery and retail.
Oh, absolutely. G&R, as they call it, hit a $12 billion annual run rate in 2025, and it's growing much, much faster than core food delivery.
But the real margin secret, the supercharger, is something else entirely.
It's the advertising business. It's already doing over $1.5 billion annualized.
Where does that ad money even come from?
It's from monetizing their own data. Sponsored restaurant listings in Eats, placements from mechanics in the driver app, and the best part...
Let me guess, the margins are huge.
They're nearly 100%. It costs them basically nothing to run these ads. This lets them subsidize pricing on rides and food to keep their market share.
Which is a massive advantage. Now let's talk about the big long-term threat. Autonomous vehicles. Is the cybercab from someone like Tesla a real risk?
It's the ultimate threat. A vertically integrated walled garden network would be very dangerous for Uber.
So what's their counter strategy?
It's actually brilliant and very capital light. They pivoted. They want to be the operating system for autonomy.
Meaning they don't build the cars?
Right. They partner with the AV leaders Waymo, Cruise, and integrate those cars into the Uber network.
But why would Waymo need Uber? Can't they just launch their own app?
They could, but AVs are incredibly expensive. You need to keep those cars running constantly to make money.
High fleet utilization.
You got it. And Uber already has the demand density, the millions of people opening the app. Uber becomes the indispensable distribution layer, the air traffic control for robo-taxis.
That's a powerful moat. But it all depends on their labor model staying intact.
And here we have the big split, the regulatory bifurcation.
In the U.S., it seems like there's been some relief.
A lot of relief. The Department of Labor backed off a rule that would have made it harder to classify drivers as independent contractors. That de-risked their biggest market significantly.
But Europe is the complete opposite story.
Europe is the cliff edge. The EU Platform Work Directive has a deadline of December 2026.
And if drivers get reclassified as employees there,
labor costs could skyrocket overnight. It's the single biggest near-term risk to their entire financial model.
So putting it all together for the listener, the structural changes, the market dominance, the AV hedge, it all supports that long-term accumulate rating. Analyst targets are around, what, $112?
Yeah, $112, $113. The transformation is very real, but that EU deadline is going to create a lot of noise and stock volatility as it gets closer.
It brings up a final provocative thought. If you're a long-term investor and you're focused on that projected $7.2 billion in free cash flow for 2026, could that regulatory panic in the market actually be the perfect buying opportunity? Something for you to mull over.